Welcome back to the deep dive. Today, we're going to get into the world of financial markets, but we're sort of throwing out the complicated charts for a bit.
Right.
We're going to focus on the one thing that really determines success or failure: psychology. Our sources are just crystal clear on this. It's not about what you buy,
No.
it's about how you think about money.
And that really is the mission right there. We are diving into the core difference between, well, trading and investing. Two completely different disciplines.
Completely different.
And we're trying to extract that crucial insight that binds them. Because no matter which path you go down, the biggest obstacle, the most persistent one, it's always going to be your own brain.
It's such a paradox, isn't it? You jump into this world thinking it's all math, modeling, forecasting. But the longer you're in it, the clearer it becomes that success has so little to do with mastering numbers and, well, everything to do with mastering what goes on between your own ears. I mean, if you've ever actually hit that buy button, you know the feeling. That instant, almost visceral reality of being in the market.
Oh, absolutely.
Let's talk about that emotional landscape because the sources really lay it out. The moment prices start to climb, you feel that irrational pull of greed.
It's hardwired. I mean, it really is. We see green, we see things going up, and we just want in.
Yeah.
The source materials quoted that classic Warren Buffett line for a reason. Be fearful when others are greedy.
Right.
It sounds so simple, but when everyone around you is seemingly getting rich, being fearful feels like the single hardest thing in the world to do.
And the flip side is somehow even worse. You see the chart turn red, and that tightening grip of fear just instantly takes over. That's when the panic sets in, right? It forces you to think about selling, even when all your research, everything you plant tells you to just hold steady.
And fear.
Yeah.
Fear is almost always coupled with denial. We've all seen people do this. They fall into that trap of holding a losing position for way, way too long.
It's that little voice.
It's that self-deception, that little whisper that says, well, the loss doesn't count if I didn't actually hit the sell button.
Right. You haven't realized the loss.
Exactly. You're trying to avoid locking it in because your ego, it demands to be proven right, even as the value is just evaporating.
And we can't forget the not-so-secret nemesis here, FOMO, fear of missing out.
Oh, that's the killer.
It might be the most destructive force of all because it doesn't even wait for you to have a loss. It just waits for momentum and it creeps in with that quiet little nudge. What if? What if this is the big one? What if you miss the whole rally and just look foolish?
Yeah, so let's step back. If every single person in the market is wrestling with this cocktail of fear, greed, and ego, what does that do to the market itself?
It sounds like it just creates chaos.
Yeah.
How do the sources synthesize this? What is the collective result of all that impatience?
Well, what's so fascinating is the synthesis. The market isn't unpredictable because it's some random, physical system. It's unpredictable because we are. Every volatile swing, every massive rally, every sudden crash. It is a direct reflection of our collective, uncontrolled hopes, fears, and, I think most critically, our inherent impatience.
And that brings us right to that foundational insight, the one that really frames this whole conversation. The source materials quoted it perfectly. The stock market is a device for transferring money.
From the impatient to the patient. And that single sentence is why the psychological hurdle is so much higher than the technical one. It's the key to everything.
Okay, so let's unpack that. The core structural difference between these two main approaches, investing and trading. They just have fundamentally different goals.
Totally different. I mean, if you're an investor, your goal is typically a long-term annualized return. You're probably looking at something in the neighborhood of, say, 8 to 10%.
The historical average.
Exactly, the S&P 500 average. The whole point is to build wealth slowly, reliably, over decades.
But the sources point out that ambitious traders, they're often targeting those same percentages monthly. And that one detail tells you everything you need to know about the risk profile and the speed you need to operate at.
Let's get into the philosophy of it. Investing, it's about building wealth over a really long time.
Yeah.
Years, even decades. So the focus is on fundamental value.
Right, the business itself.
You're not worried about next Tuesday's price. You're analyzing the business. You're looking at things like the PE ratio, how much you're paying for each dollar, profit management forecasts, long-term industry trends. It's the classic buy and hold methodology.
Where volatility is just noise.
It's just noise. Where's trading? It works completely differently. You're trying to capitalize on short-term price movements We're talking minutes, hours, days, maybe weeks. You aren't buying the business.
You're buying the momentum, the anticipation of a price change.
Exactly. And that means trading relies almost entirely on technical analysis.
A chart.
All the charts, using tools like moving averages, MCD, RSI, you name it. Because traders fundamentally believe that market psychology repeats itself in discernible patterns. They're optimizing for timing, not judging business value.
So one is like a business owner focused on value, and the other is more like a market mechanic focused on timing.
That's a great way to put it.
And the biggest separating factor there, it has to be time.
Time is everything. For the investor, time is your shield. It's your growth engine. We're talking 10, 20, 30 years for huge goals, like retirement.
But for a trader...
For a trader, time is a liability. The longer a position is open, the more risk you're exposed to. You need to close it out quickly to free up that capital for the next move.
And that difference in time is what makes compounding the investor's single greatest weapon. The sources had this example that, it really hit home.
It's a staggering visualization of the cost of doing nothing. Look at the numbers. A 25-year-old starts investing $6,000 a year until they're 67. Assuming that historical 8% return, they could end up with roughly $1.84 million.
Yeah.
But if they wait just 5 years, and start at age 30 instead,
I'm afraid to hear this.
they end up with only $1.23 million. That 5-year delay cost them over $600,000.
Over $500,000 for 5 years of waiting.
Gone.
Yeah.
Just because they forfeited the compound interest in those critical early years. That number alone should be a massive wake-up call for anyone in their 20s or 30s.
No kidding.
And traders, they see compounding differently. They're trying to compound returns by rapidly growing their accounts through frequent successful trades. Then they reinvest those profits immediately.
So it's more intense, more rapid.
It's intensive and rapid, but it's also constantly battling market friction.
Which means the risk management has to be completely different. So for investors, how do they deal with risk?
Investors handle risk mostly through diversification and just by having time in the market. Volatility isn't a crisis for them. It's a natural part of the journey.
Or even an opportunity.
Or even a buying opportunity, exactly. A chance to acquire quality assets at a discount. Time is their ultimate safety net.
Whereas traders have to be surgical.
Precisely. A trader has to use precise exit strategies. We're talking specific, non-negotiable stop-loss orders to limit their downside and take profit levels to lock in gains the second a target is hit. They manage risk by risking only a tiny, predetermined percentage on each trade.
Like 1 or 2%.
Often just 1 or 2%. Yeah, it's a game of probabilities, not conviction.
Okay, so here's where the rubber really meets the road for your actual bottom line. The costs and the taxes. This is the critical insight that I think gets overlooked when people chase those sexy short-term returns. It's huge. And the tax laws. They fundamentally and structurally favor the long-term investor. It's the clearest financial advantage of the patient approach because the government actually rewards capital that stays invested.
Can you break that down? Because the difference really impacts your real-world profitability?
Sure. Think of it this way. The tax code basically treats active trading like a second job.
Okay.
So traders, because they're holding assets for under a year, they have to pay ordinary income tax rates on any profits. And depending on your income bracket, that can be anywhere from 10% to a whopping 37%.
Whereas the long-term investor gets rewarded for their patience.
Exactly. An investor who holds an asset for at least 1 year and a day, they qualify for the much lower long-term capital gains rates. For most people, that rate is 15%.
So that could save you.
It could save you 10, 15, even 20 percentage points on your profits compared to an active trader. This single difference can be the factor that separates a successful long-term plan from a short-term struggle. It makes every single short-term trade immediately less profitable from the get-go.
Right.
And then you add in transaction costs, which just compound the problem, especially for anyone doing high-frequency strategies.
Costs are the silent killer, particularly for traders. Studies show that these hidden costs, the spreads, commissions, little bits of price slippage, they can drastically erode your returns.
How drastically?
Well, to be clear, if your strategy on paper yields, say, 20% a year, market friction and cost could easily cut that down to 10%. Or even less.
Tens of percent. So a strategy that looks amazing in a backtest can just become a money-losing disaster in the real world.
Absolutely. Because of that constant churn. It just reinforces why long-term investing, which naturally has way lower costs because there are so few transactions, often comes out ahead purely on efficiency.
We started this deep dive with the destructive role of emotion. So let's wrap up by focusing on the specific mindsets needed, because this is really where you have to decide if you're built for one strategy or the other. So psychologically, what does the successful investor look like?
They need remarkable patience and, this is critical, emotional resilience. They have to practice what some of our sources call active patience.
Active patience, what's that?
It means they do their research thoroughly, they understand the fundamentals of what they own, but they don't trade constantly. They have to possess that calm confidence to, nibble in when everyone else is selling in a panic because they know they're buying a quality asset on sale.
The sources listed a few essential traits for this: talent, intellect, knowledge, common sense, and a crucial bias toward action. It's a very measured, almost philosophical approach.
It is. Trading, on the other hand,
Mm-hmm.
it needs a psychological profile that's borderline mechanical.
Yeah.
The effective trader needs objectivity, deep self-knowledge, and just exceptional discipline.
To stick to the rules.
To stick rigidly to a predefined set of rules, even and especially when their human emotions are screaming at them to do the opposite.
And that discipline, that's the reason why the vast, vast majority of people who try trading fail.
It is. The sources offer a really heavy caution here. Studies show that all but a tiny fraction of aspiring traders lose money. It's often because they're chasing quick profits, or they feel this pressure to get revenge on a losing trade.
Instead of building the mental strength.
Exactly. Instead of building that mental fortitude, the core truth is professional traders know their greatest enemy is sitting right there in their own minds. If you can't be disciplined enough to honor your stop loss every single time, without question, you are psychologically unsuited for trading. End of story.
So this deep dive has really shown us that both trading and investing are powerful wealth-building tools, but they are absolutely not interchangeable.
Not at all.
And neither one is inherently superior. They just fit different personalities, different lifestyles, and of course, different financial goals. Success depends entirely on aligning your psychological makeup with your chosen strategy.
And that alignment, it requires some brutal honesty with yourself, based on everything we've discussed. That need for extreme, almost robotic discipline in the short term versus the need for extreme stoic patience over decades. Which of those two columns, investor or trader, better describes your natural tendencies?
That's the question.
I think that honest self-assessment, focusing on your emotional capability rather than just your financial prowess, that might just be the most profitable skill you build this year.